Abis, welcome to Trade Finance Talks TV.
Good to be here.
Thank you. So here we are at the ITFA and BCR Publishing Trade and Investment Forum. You're from Fitch Ratings, but it would be great to hear a bit more about what you do and what that involves.
Sure, no problem. So I'm an analyst in the fund and asset manager ratings team within Fitch. Been rating funds and asset managers for probably 15 plus years, including trade finance funds.
Brilliant, thank you. So I guess the key question is, what is the main difference between credit and fund ratings?
Good question, Deepesh. So traditional credit ratings that we're used to, it's sort of an opinion on the likelihood of a debt security meeting its commitment or its obligation. So it's, for example, it has a principal payment on a fixed date or principal and interest payments, and what's the likelihood of meeting those payments. So that sits on the liability side of a transaction. If you look at a fund, for funds on the liability side, you have units, and units are akin to shares. So there's no commitment of we'll pay this amount on this date. So it's not the likelihood of paying on a debt style security. Rather, it's just speaks to the, I'll say, what's the value of the pool of assets. So when we're rating funds, we're not looking at the liability side, we're looking at the pool of assets. What's the likelihood, or what's the vulnerability to default losses on that pool of assets from credit risk and also from market risks. And that's a bit unique when we look at market risks like interest rate risk and currency risk, that type of thing.
Sure, and so let's talk a bit more about the trade finance sector. What are some of the challenges with getting ratings within this sector?
Yeah, so I think, so firstly, there's, I'll say generally, high level, there's the image problem which the industry is getting over. So a few years back, some high profile trade finance funds, or what were sold as trade finance funds, they ran into some issues. And I think the sector or investors just tarred the whole industry with that brush. So I think the industry is taking time to rebuild that image, or to educate investors as to the differences between those funds that ran into issues and more conventional trade finance funds. Then specifically, if we're looking at just the asset and what some of the challenges, I'll say on the securitization side, a trade receivable securitization, for example, the portfolios are probably too concentrated compared to, say, consumer loans. So when you have these high concentrations, to be able to rate that, we probably have to have a bottom-up sort of approach. We have to sort of understand what's the credit risk on each of those underlying exposures, as opposed to being able to take a sort of portfolio view, because we have the statistical data set to be able to take that sort of view. So that's, I'll say, from the ABS sort of side. If you look at fund ratings, some things that we had to grapple with are, how do we treat trade credit insurance? So trade credit insurance is very different to a guarantee, for example. So a guarantee, the timeliness of payment is still there. So we're able to, and it's irrevocable. There are no exclusions, etc. So with an insurance contract, you have exclusions, you have an excess, so it's not a full payment, and there's also a timing issue in terms of how long it takes from when a claim is made, or from when, I'll say, a default happens to when you can make good on the claim. Then there are a few other challenges around, say, unrated obligors. So for fund ratings, one of the key inputs is what's the rating of the asset, and that's how we sort of map to our vulnerability to default risk. Now, if you have unrated securities, let's say they're operating companies of, it could be a rated parent, but it's just an operating company, and you have a lot of these in the SME space within trade finance. So how do we grapple with that unrated subsidiary of a rated parent? So we have to sort of grapple with that. And then another challenge is with the structures. So structures could be not conventional or traditional fund structures. With trade finance, you have like sometimes SPVs sat in the middle. So the SPV buys the trade finance assets and then repackages it as a note to sell into a fund, for example. And if we wanted to rate that, we'll have to look at what's the rating of this note, except we can find a way to look through to the underlying assets. So these are some of the challenges.
Yeah, very, very interesting. And I think throughout the day we've been talking about this notion of trade finance as an asset class and bringing more liquidity in from capital markets. Is more education needed? And would you say that we do need to build a bit of a bridge between the trade finance community and investors?
Yes, I think so. I mean, you have sophisticated investors, and but these tend to be, say, banks or insurance and pension funds. So they understand the asset class, and so they're able to invest in bilateral type arrangements. But once you want to get corporate treasurer investors, I think that's where probably a lot more education is required. So they understand what a trade receivable is, but what's all this structuring? What does this really mean for my, what credit risk am I really taking? What liquidity risk am I really taking here? How exposed am I, or how exposed is this instrument to market risk movements and the like? So I think that's where some education or for those corporate treasurers, or for those, I won't say less sophisticated investors, but those, let me say, cash investors, they're just more interested, just make it very simple for me. So I think that there's a gap between what's done and then just making it very simple.
Abis, thank you very much for joining us on Trade Finance Talk TV here at the ITFA BCR Trade and Investment Forum.
Thanks for having me. Pleasure talking.